it seems like a cheat code. Like, why wouldn't I just let them keep running, not have to pay the taxes? I can use the loan as my source of liquidity. I think the other part of this question here that we cut out was he was saying, like, even if rates are higher, they're not above the historical long-term return of the stock market, I'll still be fine. Bill, what say you?
Yeah, Ben, I think that's generally it. I do actually like the premise, Alex. I like the idea here, which is how can I get creative? How can I defer on taxes? What can I do? And I would argue, Ben, that a lot of young investors, in my opinion, don't take on enough leverage. Going back 18 years of my career, I've never advised anybody paying more than the 20% down payment, and I've never advised prepaying a mortgage because one of the few ways that an individual investor can take leverage in their portfolio is through a mortgage, through a real estate loan, right? And that's one of the few things that's available for somebody in their 20s and 30s that has a 20 or 30 or 50-year time horizon in many cases. But here's the problem with margin interest, Ben. John, can we chart on Q4 here? You're looking at best, a 10% interest rate in today's environment, right? And Ben, just we have a pretty rosy, view here of the U.S. economy. We think that things are going to be pretty good for diversified baskets of stocks, bonds, and mutual funds. But 10% to me, Ben, is at the upper limit of what I would expect from a diversified portfolio each year. So in my opinion, if you're deferring on taxes, okay, that's a benefit. But if you're paying 10% in today's economy to borrow money, that's a very, very expensive interest rate.
So we were seeing 3% rates a few years ago when rates were on the floor. And that's the other part, is that these are variable rates, right? You're not locking them in like a mortgage. What are the other downsides if your portfolio falls out of bed and you have to potentially pay the loan back?
Yep. And that would happen, Ben, if and when you get a decrease in your market value of your portfolio, right? That's when those margin calls come a-calling. And if that's the case, not only then have you paid all that interest up to that point, but in the event that you had a decrease in your market value, now, okay, great. Now you don't have any taxes to deal with, but you're taking distributions then from the portfolio ahead of a potential rebound. So I just don't think margin's the way to go. I would pursue maybe a securities-backed line of credit. I think you can get rates today in the 6.5–7% range. But to me, Ben, that's still too complicated. Like if you look at the U.S. 10-year Treasury rate, we're somewhere between 4–4.5%, somewhere around there. I wouldn't want to pay more than that to borrow, right? Because the post-tax dollar amount that you're using there just isn't worth it. And back to death and taxes, you're going to have to pay tax on this thing eventually. You're probably just going to have to bite the bullet working in your portfolio